Welcome to Money Matters. I'm Emily Johnson, Certified Financial Planner and Managing Director of Polaris Capital Advisors. Today we're going to be talking about a few macroeconomic themes and their impact on the market. Primarily we're going to be talking about the pending fiscal cliff that we've all heard about and what the impact has been not just on the market but also on managers' outlook for their businesses going forward and what that's going to do to the markets over the next half of the year. So first, before we get to that, let's talk a little bit in generalities about where the market's going. We're continuing to see the market trend sideways into the third quarter as we continue to be plagued by many of the same themes that we've experienced for well over a year now. Specifically, of course, the themes that you're most familiar with. Number one is going to be Europe and the European debt situation, whether we're discussing Greece, Italy, Spain, Portugal. The debt crisis remains the same throughout. We're looking for some sort of resolution over there, and of course that's just a slow slog through the European politics. Number two is the potential for a gradual slowing, or perhaps just the fear of a gradual slowing in China's economy and what kind of an impact that might have on the overall global economic picture. Number three is the presidential election here in the U.S. We're definitely starting to see the market begin to react, perhaps even just a little bit, but ebb and flow perhaps, to the public polls as we're seeing some of that information be released, and I'm sure that that's going to continue with more advanced movement as we see the presidential election proceed. And lastly, and perhaps most importantly, is the pending fiscal cliff that everybody is beginning to talk about more loudly. That's the name. The fiscal cliff is a name that Ben Bernanke gave to describe the many major fiscal events that are slated to occur simultaneously at the end of 2012 and beginning of 2013. Some of these events that we're talking about, of course, include the expiration of the Bush-era tax cuts, the expiration of the payroll tax cut, which primarily benefited employees, and other tax relief programs are also slated to end. In addition to that, we're going to see the first half of the $1.2 trillion in spending cuts that Congress agreed to back when we were having the situation with our debt ceiling several months ago, and Congress decided that they were going to cut $1.2 trillion in spending. $600 billion of that is slated to take effect in the first quarter of 2013, and there are lots of thoughts on how that's going to impact the economy. In addition to that, there's a great likelihood of additional taxes or spending cuts that Congress is going to need to implement as we rapidly approach that same debt ceiling again. The conundrum that we ran into several months ago where we hit our debt ceiling and Congress couldn't agree as to what sort of actions to take, we're about to hit the exact same thing again here in just about 5 or 6 months. And so it's expected that some sort of either additional taxes or cuts are going to have to come as a result of that as well. And lastly, of course, are the additional taxes that are slated to take effect in 2013 due to the Healthcare Affordability Act, better known as Obamacare. So we have lots of things coming down the pike that are impacting or creating this fiscal cliff that we need to be concerned about. And that's the topic that I'd like to dig a little bit deeper into in this first part of the show. As it seems to be a major underlying issue. It's constantly tucked behind the European issue. As I heard one analyst say the other day, they feel that the European issue is sort of, if we're talking about college, it's the major and the fiscal cliff is the minor. I think that's probably about to switch gears as we get into the end of 2012 and the beginning of 2013. But this fiscal cliff is driving not only the markets, but it's also driving CEOs and managers' actions as we go into the second half of 2012. So let's talk exactly what would happen if we did fall off this proverbial fiscal cliff. Well, with the upcoming spending cuts, number one, the government is slated to save about $600 billion. But there's significant fear among economists that those cuts could throw this current tenuous U.S. economy back into a recession, or at the very least, it could slow our already slow growth rate. It's anticipated that these cuts, if they take place, could cut our growth rate in 2013 from an anticipated 4% down to a relatively anemic 0.5%, which obviously would not do much for job growth, and continued investment in the economy. So there's obviously a lot of variables at work here, and we can't get into all of the details of this. But the one variable that's creating the greatest fear among managers is the fact that these fiscal issues are coming to a head during a highly contentious presidential election, which pretty much guarantees that no action is going to be taken to avoid these events or to fall off this fiscal cliff, to use Bernanke's words, before the end of the year. It's highly unlikely that anything will happen within our Congress that will help us to avoid this or to address our fiscal issues between now and the end of the year. And although we've talked about this issue continuously for the past 6 months, we're really seeing its impact just over the first few weeks as managers are beginning to release their second quarter earnings and are providing guidance for their third quarter earnings. At this time of year, and we've talked about this in previous quarters, managers come out and they say, well, this is how we did in this previous quarter, but going forward, this is what we see. And while the previous quarter was healthy, definitely there's a lot of sentiment of uncertainty among managers, and most of it is centered around this fiscal cliff. Of course, a portion of it is Europe, but a lot of it has to do with this fiscal cliff as managers are not able to take proactive growth steps such as hiring and investing in uncertain environments. So we'll undoubtedly watch this issue play out over the next few months as the presidential election takes shape. And it's definitely something that is on managers' minds and CEOs' minds as we move into the third quarter. So if there's some resolution, I think we'd start to see a movement up in the markets. But without resolution, I wouldn't be surprised if we continue to trend sideways. So these are some of the major themes that are impacting the market this week, like many of the weeks over the past several months. This uncertainty, of course, begs the question of, do you, as an investor, stay in the market, or is it time to run for the hills? And we'll be right back to answer that question. So stick with us. You're watching Money Matters. Welcome back to Money Matters. We've been talking about macro issues impacting the market, and more specifically the fiscal cliff and the uncertainty that is creating for investors and for money managers. So one question that we receive all the time is, given the current uncertainty and volatility in the markets, should I stay invested? And it's an excellent question, and obviously, fear is typically stronger than greed. And this market, when I say this market, I mean the market that we've been experiencing for the past 18 to 24 months, definitely questions investors and managers' resolves. It's a market in which significant risk exists on both sides of the equation. If you put your money to work in the market, you're going to be subject to risk, but at the same time, sitting on the sidelines also creates the possibility of risk, one in the form of inflation, and two, of course, in missed opportunities. So in our view, and it's one that's shared by many money managers and many analysts, is that investors still are better served by putting their money to work, but doing so cautiously and doing it with significant focus on asset allocation and their risk profile. So what does that mean? Well, let's first look at the alternative to investing in the markets, which is basically moving all of your funds out of the market at this point and placing them in a savings or a CD that at this point has next to no yield. So remember, as I said before, fear is always a stronger driver than greed. I can't tell you how many phone calls I receive after a negative day in the market, but if we have a gangbuster day in the market, I don't get any phone calls. So if you want to take the tack of the fear tack and removing your funds from the market, this appears to be a relatively low point in the market. And we're looking at that based on price to earnings multiples and also the relative health of corporate balance sheets relative to where they've been in the past. So we do believe that right now, as a point in history, we're looking at a relatively low point in the market. So pulling funds out of the market at this point may be pulling them out at a low point. Of course, nobody knows, there's no crystal ball, but based on the analytics that we use, we believe that you're pulling them out at a relatively low point and that there's greater opportunity in the future. And again, there's no exact science. I mean, obviously, history and finance imply that companies have a lot of capacity for growth at this point, but managers are definitely sitting on their hands right now until they have some visibility on the fiscal horizon so that they can act in the form of hiring, investing with confidence. So the reason that we're seeing the market continue to move sideways and with gyrations is because there is no visibility on where we're going, and it's difficult for managers to act in that environment. Further, we will achieve some visibility in the coming months as the presidential election plays out. This uncertainty that we're experiencing, it cannot last forever. Unfortunately, it could be that when the dust settles, we could see a strong fiscal cliff, and we're not just going to fall off of it, but we're going to fall off of it into a chasm that's filled with raging waters, or we could see the positive side. But if we do fall off into a chasm that's filled with raging waters, then obviously this is a reason that we feel that it's prudent to maintain a healthy percentage of your investable funds, say anywhere from 20 to 25% in cash. And this is where we get into the discussion of the overall asset allocation. If you view your investments as a pie, as I'm sure many of your managers and investment advisors look at with you when they're reviewing your funds, we anticipate, or we recommend right now, anywhere between 20 and 25% in cash. And again, this is not supposed to be your emergency money that we're talking about. It's only the funds that you can reasonably risk with a short-term loss. So at this point, if you're maintaining that 20 to 25% in cash, you're doing that for the purpose of taking advantage of value opportunities in the future. It might be okay to sit on the sidelines with 20 to 25% and watch the market continue to go up if we wind up with positive economic stimulus. That would be fantastic, but at least you're maintaining a hedge of 20 to 25% of your funds in cash that you can then put to work in the future if we do see more positive dynamics come to fruition. So then the question, of course, is do you put the remainder of your funds, the 75 to 80%, in equities or hedge funds or risky assets? And I would definitely say not likely at this point. Is that going to be a strategic idea? This is where your allocation is going to be most important with this remaining 75 to 80%. And we have two primary asset classes. Again, this is a major simplification, but two primary asset classes that we're looking at. One is going to be fixed income bonds and also stocks or equities. So within fixed income, let's focus there for a second. We're faced with historically low interest rates, so we're not going to be clipping the 7 to 8% coupons that our grandparents did, or even the 4 to 5% coupons of just a few years ago. Right now, we're looking down the barrel of a 10-year note that yields only about 1.5%. It's been down to 1.4 and change, which is not too exciting from a yield perspective, setting your money aside for 10 years and receiving only a 1.5% coupon. But more importantly here is considering the risk for principal erosion if interest rates start to rise. And we've looked at that teeter-totter before of if interest rates go up, then your principal is going to go down. It's difficult to say that we're not going to go up from an interest rate perspective at this point, since we're at rates that truly are historic. We haven't seen these rates in beyond decades. So we've seen this continued rush to safety with funds continuing to race into treasuries. That's kept rates continuously artificially low. But when rates turn, there is going to be the equivalent rush back out again, perhaps even faster. And this is going to be extremely painful for bondholders that are continuing to hold on to their bonds. So that said, though, we also need to have the caveat of some percentage of allocation towards bonds does make sense when you consider this continued uncertainty that we're looking at in the marketplace. And that's why there's been a continued run of funds into treasuries, because there is an anticipation or the possibility that we will see a sideways move in the markets, or perhaps even a negative move in the markets for the foreseeable future. Call that 6 to 9 months. If that's the case, then it is more prudent to keep some of your funds in bonds, even if they are just short-term bonds with a relatively small yield, because you will be yielding more than you would in the equity markets, and certainly more in cash. So again, we have to plan for two different scenarios. If we maintain this financial quagmire into 2013, it's reasonable to assume that rates are going to continue to remain low and equities will remain uncertain. So this is when you have to look at your personal situation, and depending on your age, your risk tolerance, many other factors, and consider an allocation anywhere from, say, 10 to 40% might make sense for your situation. Again, depending on how much risk you can stomach, your age, how much funds you have saved relative to your needs, etc. But the focus in fixed income needs to be on very, very short duration bonds. I would avoid looking at bond funds, primarily look at very short duration bonds, municipals, corporates, agencies. These bonds, while they're still exposed to increases in rates and principal erosion, are much less exposed than long-term bonds tend to be. So lastly, what are we looking to do with the remaining portion of our investments? And again, this is simplification. We're just looking at cash, fixed income, and stocks. But lastly, we're going to be looking at stocks and what kind of an allocation should we be looking at right now towards stocks, given the economic factors that are impacting the market these days. A lot of people ask, should we invest in stocks at all? I strongly believe yes, but again, it's going to be based on your risk tolerance, and I'd be looking at an allocation, again, between 25 to 50%, whatever it is that makes sense for you based on your time horizon and long-term growth horizon. So there's certainly short-term risk and volatility to stomach, but there appears to be significant value in many corporate balance sheets, which is why I feel that it does make sense to invest in equities now. Again, we talked about the fact that historically, based on a lot of metrics that we have to look at, that it does appear that we are at relatively low levels relative to previous historical times, and also that we have very strong balance sheets, which makes a lot of sense for investing in corporations, especially corporations that have strong cash flows, strong dividends, that will at least hopefully help you to cushion any blows that might come over the next several months. So I'd be looking at that. I'd be looking at cash flows, healthy balance sheets, growth markets. Managers have weathered the storm. As in anything else, you just have to do your homework. Same thing with fixed income. You have to do your homework and look at the creditworthiness of the bonds and/or bond funds that you're going to be investing in. So my summary response, given the current uncertainty and market volatility to the question of should I stay invested in the markets, is definitely a resounding yes. But I would definitely say do so with caution and with a keen eye towards your own personal risk tolerance and the ability to seek value. I think that long term that is going to be your best option. But I'd also suggest reviewing your investments and your overall asset allocation on a more frequent basis, say at a minimum 2 times a year, but definitely better to do it quarterly, either on your own, with your investment advisor, whoever it is that you work with, because markets may start moving more quickly as we start to get greater visibility, and that could either be in the positive direction or in the negative direction. And in these types of environments, we're just not sure which direction that could be. So it's definitely worth making a commitment to reviewing your investments on a more frequent basis, as I said, preferably quarterly, at a minimum 2 times a year, and I think that that will serve you well. So hopefully that sheds some light on this issue, or at the very least has generated some critical questions for you about your own financial plan given the environment that we're in. I certainly look forward to any follow-up questions that you may have on this topic. It's one that I'm confident that we're going to be dealing with for months to come, so I'm sure that we'll receive many questions that we'll address right here. But before we get to that, we're going to be back in just a minute with our parting shots. Thanks for joining us. This is Money Matters. We'll be right back. Welcome back to Money Matters. In this discussion that we're having on asset allocation in an uncertain and volatile market, I would definitely be remiss if I didn't address some of the alternative investment classes such as real estate, REITs, commodities, as well as things like annuities, master limited partnerships in this discussion as means of weathering market volatility. Now is an excellent time to review any alternative investment holdings that you currently hold to see how they're working within your portfolio. Usually alternative investments are designed as to be a hedge, to provide additional income. There's lots of different reasons for them, to reduce risk. So you want to make sure that you look at your alternative investments and see, are they working in the appropriate way within your portfolio to derive the appropriate benefit? Are they generating appropriate income? Are they reducing overall risk within your portfolio, etc.? These are some of the things that you want to be looking at when it comes to your alternative investments. Are they helping you to maintain a hedge when it comes to inflation? A lot of these things are questions that you might want to be asking your investment advisor when it comes to your alternative investments. Why are we invested in these? Are they doing what they're supposed to do given this market volatility? Because now is the time that a lot of those alternative investments probably are earning their keep. And then secondly and lastly, if you're a person who cannot, whether it be financially or emotionally, handle any market volatility, then I would strongly suggest that now is a reasonable time to look at options that are available in variable and index annuities. And while sometimes these annuities get a bad rap, right now, and as has been in history, these annuities typically offer a very strong guaranteed growth rate on the annuitized base that may offer greater peace of mind for some investors than typical investments in the market. Right now we're seeing still, even in bad interest rate environments, we're still seeing 7, 8, 9% guaranteed interest rates on annuitized bases. But of course there are some handcuffs that are attached to those, and that's some of the negative that comes with annuities. So, but it's definitely something that's worth looking at. If you're a long-term investor, you're looking for some more peace of mind, you're looking to be able to sleep at night, and these markets aren't allowing you to do it, it might be worth actually taking a portion of your funds and allocating it towards whether it be variable or index annuities for that purpose, so that you get that guarantee and the potential for some market performance, but more so the guarantee. So those are some other things to consider given this market. And of course, we always are looking at everything in a vacuum. There's lots and lots of variables to consider. And I would welcome any questions that you have about your situation, questions in general. So please touch base with us with that. That is going to be it for this week. Thank you so much for joining us. We welcome all of the information you've sent us, all the questions, thoughts, comments. Please keep it up. Look forward to seeing you next week. I'm Emily Johnson, and we are here where your money matters. Have a great week.